Double entry bookkeeping. Yes, we are going to learn that how we will debit which accounting head, and we will also relate that accounting head with the main head. So this would be learned through a practice. But before starting that practice, let me tell you the history of double entry bookkeeping. Remember this gentleman, Luca Pacioli. He is in fact considered as father of accounting. In 1494, he introduced double entry bookkeeping. He was in fact a mathematician, but his inclination towards accounting was also there. He told us that each transaction causes increase or decrease in two accounting heads. And such increase or decrease should be analyzed as debit and credit. So remember this gentleman, Luca Pacioli. Okay, let's start practice to learn this debit and credit. There are few transactions that I will discuss with you, and I will also discuss how to analyze debit and credit for each transaction. Okay, let's start. Transaction number 1. Capital introduced in the business, rupees 10,000. So what we have to do in this practice, we have to identify relevant accounting head, and then we have to relate that with its respective main head, and then we have to see either there is an increase or decrease because of that transaction in the main head, and then finally we will decide which accounting head should be debited and which should be credited. Okay, let's start. Capital introduced in the business, rupees 10,000. Look, here it is not written that owner has brought cash. Owner has brought cash. But it is understood that owner will be bringing cash as capital at the time of introduction, resources which belong to this owner into the business, but the value is given. So what we see that when we analyze this, it would be giving us two accounting head, one cash and one capital. Relate each accounting head with its main head. Cash is asset and capital is owner's equity. And then recall the group. Asset belongs to debit group and owner's equity belongs to credit group. And now apply the rule of analyzing debit and credit, that if there is an increase in debit group, should be debited. Look, when this cash was introduced as capital in the business, we see that cash is an asset, asset belongs to debit group, and because of introducing cash into the business, there is an increase in the assets. So such increase in asset, which is a debit group, would be analyzed as debit. Okay, would be analyzed as debit. Well, at the same time, the second accounting head, we are analyzing second accounting head, which is capital. Capital belongs to main head owner's equity. Its group is credit. And now we see that our owner's equity is increasing. This you can relate to that equation as well, that when the cash was introduced in the business, owner's equity was increased. So this credit group, when it will be increased, will be credited. This is as per the rule that we have already discussed. Well, so the second transaction. The second transaction is purchased furniture for cash, rupees 4,000. Two accounting heads. One is cash, yes, you are right. And the second one is furniture. And both are assets. Let's see. In this second transaction, cash and furniture, both are asset having debit group. So, when we are paying cash, we are having furniture with us. So, by making this payment, there is decrease in assets. So, decrease in assets, there is decrease in assets, which is a debit group. When decrease will be credited. And furniture, since it's also an asset, furniture is increasing the assets because we have purchased furniture. Furniture is in the business now. It is increasing the assets. And this increase in assets, since it's a debit group, increasing will be debited as per the rules. Well, next transaction. Purchase of goods for cash. Here again we are having cash and purchases. These are the two accounting heads. Just see, one accounting head purchases, the second accounting head is cash. Purchases are expenses and cash is asset. Debit group. Expenses are increasing, whereas we are making payment in cash, asset is decreasing. So when expense debit group increases, analyze it as debit, and when asset debit group is decreasing, analyze this as credit. Well, next comes sold goods for cash. When we see sold goods for cash, there is cash and sales. Cash is asset, debit group increasing debit, sales is income, credit group, income is increasing, credit. Okay, next comes rent paid in cash, rupees 2,000. Let's see, rent is expense, debit group, expenses are increasing, analyze it as debit. Cash is asset, asset is debit group. We are making payment in cash for this rent. So it is decreasing our assets. So assets, debit group decrease, credit. Well, next is owner withdrew cash for personal use. Let's see, this number 6, drawings and cash. Drawings, owner's equity is decreasing. Credit nature, when decrease, we have to debit it. And asset debit group is also decreasing. We are making payment in cash. So credit. Okay. And salaries paid in cash, 200. What we see that salaries are expenses and cash is asset. Both are debit group. When there is decrease, it will be credited, and when there is increase in debit group, it will be debited. Next comes bought goods from John Smith on credit. So remember, this is a credit transaction and we are buying goods from a person who is a supplier. Okay, let's see. We have purchased goods. So purchases is one accounting head, which is expense. belongs to debit group and causing increase in expenses, debit. And our creditors, who are the liabilities having credit group, are increasing, therefore should be credited. Well, next comes sold goods on credit. Again, see, it's a credit transaction. We are selling goods to Henry. Henry is our customer now. Well, so sales are income credit group. So we have to credit this because it's increasing. Debtors are assets. We have learned this already. Belong to debit group. And it is increasing our assets. Should be debited. Okay. And the last transaction of this practice question is received cash from Donald. So we have received cash from Donald. Why we are receiving cash from Donald? Because Donald was our receivable. Okay. So let's see. Donald was our receivable debtor. So we are receiving cash from this receivable person who was our debtor. Debtor is asset. Cash is also asset. Since we are receiving cash, cash is increasing. Increase in debit group, debit. And we have received cash from debtor. Means debtor balance is decreasing now. So decrease in debtor's balance is causing decrease in assets. So our asset, which is in fact the debit group, would be credited now. Well, so this was the practice, very, very interesting, in which we learned that each transaction is having debit and credit at the same time. So debit and credit are equal. And for purchases, yes, these are very important tips to remember. Whenever there is purchase of goods, use accounting head purchases there. Whenever there are sales of goods, use accounting head sales over there. Whenever there is personal use of owner, use accounting head drawing over there. And whenever investment is coming from the owner in the business, use capital as accounting head, and capital is credited there. Thank you very much.